Yo, what's up, guys? It's your boy Looney. The market is red today. Stocks are pulling back and crypto is dipping, but that actually sets up for one of the best strategies out there for creating consistent cash flow from your portfolio, even if you're just starting with $1,000. But before we get into this video, quick shout out to the Discord. It is free to join. And then I also offer a premium membership that's $8 a month. And that gives you access to one-on-one coaching, trade callouts. I have an option selling course, giveaways, and more. You can check it out. All the links to that are in the description. But what I'm talking about is the wheel strategy. It's one of my favorite beginner option strategies because it's simple, repeatable, and works especially well in any market, especially on red days like we're seeing today. So let me break it down step by step. And I actually have one of these going on, or I have a few of these going on. And if you don't know the wheel strategy, it is selling a cash secured put and then selling a covered call. So step one is to sell a cash secured put. And I have this Mara cash secured puts that I've been doing. And let's do the one that I opened today. So I opened this one today because of this dip, and I'm agreeing to buy these shares at this strike price. And you could see you only need about $1,000. This trade, you need about $1,350, but you can go lower. You could choose stocks that are a little bit cheaper at around that $10 mark. But I'm choosing Mara because that's the one I did today. Oscar is another one that I've been doing. But the idea is simple. You get paid up front, which is called a premium, and you're agreeing to buy the stock at whatever strike price you choose. So this is a 13.5. I'm agreeing to buy Mara at $13.5, and I'm comfortable owning the shares at this price. And you have to buy 100 shares. With options, it's always 100 shares. And to do this agreement, I got paid $44. So that's the premium. And depending on what stock you choose is how much premium you get, or where their stock is how much premium you will get. But this money is in your account right away. That premium goes into your account right away. It doesn't seem like a lot, but these small wins stack up. So let's say you get assigned. An assignment, all it is you are forced to buy the shares, which you're already comfortable wanting. And you get to own it at whatever strike price you chose. So with Mara, I actually got assigned. So let's stick with Mara because I am sort of running the covered call or the wheel strategy with this. So if you get assigned, you sell a covered call. So let's say the stock does dip, like I said, and you do get this assignment like I did. I got assigned at around $17, $16, which is actually a good thing. You now own the shares. So I own 200 shares because I did 2 contracts at this price. So instead of just holding these shares, you immediately sell a covered call against your shares. And you want to be choosing a strike price that is higher now. And that's what I did. I have this $18 call, and I'm essentially saying I'm okay with selling my shares at $18. And for doing this agreement, you get paid a premium. Now mine was a roll, so rolls act a little differently, but the idea is the same. We could use a different stock like Oscar, like I was mentioning before. And you could also run the wheel on this stock as well. It's pretty cheap. But this covered call, I got paid up front $33. I went a little safer with this one because I didn't do it at the best time. With covered calls, you want to be doing them when the stock is shooting up. But you could also do it on any sort of day. It really comes down to what you're looking for. So I did a few weeks out, and this is expiring in 9th of September. So still a few weeks, and I'm letting this stock, or I'm letting my option theta decay and lose value and therefore expire worthless. And I get my option premium as my net gain. So again, you collect that premium, and you can see this is monthly or weekly cash flow. And just by doing this, you can add up, and it's very repeatable. So that is the wheel strategy. If you get assigned, you will be forced to sell these shares at whatever strike price you chose. So Oscar, it would be $18 a share is what I'd sell it for, which is actually pretty good because I bought it for $14. So that's around $400 of profit. And then you also add in those premiums. But once you get assigned on the covered call, you can get right back to step number one and sell another cash secured put. So if you don't get assigned, you just keep selling your covered calls week after week or month after month. But either way, you're constantly getting paid. So that's the beauty of this strategy. You're not gambling on whether the market goes up 20% tomorrow. You're creating that consistent cash flow, whether the market goes sideways, dips, or even rallies. And red days like today are actually some of the best setups because premiums are juicier when the market is fearful. So to wrap this up, with $1,000, you won't get rich overnight, but you could start stacking small wins week after week, and over time, that consistency compounds. So that's why I love the wheel strategy and why I think every beginner should learn it. So if you want me to break down my own trades or you like this video, don't forget to leave a like, comment, and until next time, peace.